You know that feeling when you check your retirement account and see all those different funds and you think to yourself, wow, I'm really playing it safe here? Like you've got your large cap fund, your mid cap fund, your small cap fund, maybe some international exposure, a bond fund, because your advisor said you should at your age, and you feel pretty good about it because everyone says diversification is the key to protecting your wealth. And then you read about someone like Warren Buffett, who literally has most of his personal wealth in Berkshire Hathaway stock, or you hear about some tech founder who kept 80% of their net worth in their own company and became a billionaire. And you think, wait, am I doing this all wrong? My name is Tom, and I spend way too much time thinking about why the wealthy build their portfolios completely differently than what we're told to do. If you're someone who has been maxing out your 401k, spreading your money across a dozen different index funds because that's what you're supposed to do, but you look around and wonder why the people getting truly wealthy seem to be doing the exact opposite of what every financial advisor tells you, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Here's the thing that's going to sound controversial, but I need you to hear me out on this. The diversification advice that gets hammered into regular investors is actually preventing most people from building real wealth. And I'm not saying diversification is bad. I'm saying the way it's taught to everyday people versus how actual millionaires and billionaires use it are two completely different strategies that just happen to share the same name. Look, when you and I are told to diversify, what does that actually mean? It means spreading our money across as many different things as possible so that we never lose too much. It's a defensive strategy. It's about not losing. But when you study how people actually accumulate significant wealth, like we're talking going from middle class to multiple millions or even billions, they do the exact opposite during their wealth building years. They concentrate their resources into one or two things they deeply understand, and then they go all in. Let me give you some numbers that might shock you. A study by Fidelity looked at their customer accounts over a 20-year period from 1992 to 2012, and they found something fascinating. The accounts that performed the best were the ones where the owners had either forgotten about them or literally died. I'm serious. The second best performing accounts were ones where people had severe amnesia or were basically too busy to check them. The worst performing accounts were the ones where people were actively managing them, constantly rebalancing, moving money around, trying to optimize their diversification. The average actively managed account underperformed a simple buy and hold strategy by about 2.5% per year. That might not sound like much, but over 20 years on a portfolio that started at $100,000, that's the difference between having about $380,000 and having about $610,000. That's a $230,000 difference just from not messing with your money. But here's what most people don't realize. That study was looking at people who were already invested. The real wealth gap happens way before that. It happens in how you allocate your most valuable resource, which isn't even your money. It's your time and energy. Think about it this way. You've got a friend, let's call him Jake. Jake works a regular job making $75,000 a year. He's smart about money. He reads all the personal finance blogs. He's got his emergency fund. He maxes out his 401k. He's got a Roth IRA. He's even got a taxable brokerage account where he buys index funds every month like clockwork. Jake is doing everything right according to conventional wisdom. He's diversified across large cap, small cap, international, bonds, maybe even some REITs for real estate exposure. And you know what? Jake will probably retire comfortably at 65 with maybe $2 million if everything goes well. That's actually pretty good compared to most Americans. But then there's Sarah. Sarah makes the same $75,000 a year at her job. But instead of spending her evenings watching Netflix and her weekends relaxing, Sarah spends that time building a side business. Maybe it's an e-commerce store. Maybe it's a service business. Maybe it's creating online courses. For 3 years, Sarah barely saves anything. She's putting every extra dollar and every spare hour into this one thing. Her friends think she's crazy. She's not diversified at all. All her eggs are in one basket. But by year 4, that business is generating $50,000 a year in profit. By year 6, it's doing $200,000. By year 8, Sarah sells that business for $3 million. Sarah is a millionaire at 38 years old, while Jake is still grinding away, hoping his index funds compound over the next 27 years. Now you might be thinking, okay, Tom, but that's survivorship bias. What about all the Sarahs who tried to start a business and failed? And you're absolutely right to ask that. Here's the thing though. The difference isn't really about taking wild risks versus playing it safe. It's about where you're concentrating your focus and what you're trying to optimize for. The traditional diversification strategy that financial advisors push. And look, I'm not blaming them. They have legal obligations to give you this advice, but that strategy is designed to answer one question. How do I protect money I already have? It's preservation focused. But if you're watching this video, if you're someone who's trying to build wealth, not just preserve it, you're asking the wrong question. The question should be, how do I create value and capture that value efficiently? Let me break down how actual wealthy people think about concentration versus diversification, because there's a pattern that shows up over and over again. And I've spent hundreds of hours reading interviews, biographies, and academic studies on wealth accumulation, and this pattern is crystal clear. Phase 1 is concentration. This is the wealth building phase. During this phase, which typically lasts between 5 to 20 years, wealthy individuals put the vast majority of their time, energy, and capital into one or two ventures they understand deeply. This could be building a business, developing a specialized skill that commands high income, building a real estate portfolio in one specific market they know inside and out, or making concentrated bets on companies or technologies they've researched exhaustively. The key here is they're not spreading themselves thin. They're becoming deeply expert in one area and using that expertise to create asymmetric returns. Here's a concrete example. In 2004, Peter Thiel invested $500,000 in a little startup called Facebook for a 10.2% stake. Now, conventional diversification wisdom would say, that's insane. Putting $500,000 into one early stage startup, that violates every rule of portfolio construction. But here's what people miss. Thiel wasn't gambling. He was on Facebook's board. He understood the business model, the market dynamics, the competitive landscape. He had insights that public market investors couldn't possibly have. When Facebook went public in 2012, Thiel's stake was worth about $1 billion. He eventually sold most of it for over $2 billion total. That's a 4,000x return. You cannot get that kind of return from a diversified portfolio of index funds. It's mathematically impossible. But here's where it gets really interesting. After wealthy people build their wealth through concentration, they move to phase 2, which is strategic diversification. Notice I said strategic, not standard diversification. Once Peter Thiel made his billions, did he keep it all in Facebook stock? Of course not. He diversified, but he did it in a very specific way. He diversified across different asset classes, venture capital investments in companies he understood, real estate, some public equities, hedge fund strategies, even Bitcoin and other alternative assets. But here's the key difference between how he diversifies and how normal people diversify. Each position he takes is still relatively concentrated and based on specific insights or edge he believes he has. He's not just spreading money around randomly to minimize risk. He's strategically allocating capital to areas where he believes he has an informational or analytical advantage. Now let's talk about the math that nobody wants to explain to you because it's kind of depressing if you're just relying on traditional diversification. Let's say you start with $10,000 and you want to turn that into $1 million. That's a 100x return. If you put that into a diversified portfolio of index funds, historically, you might expect about 7 to 8% annual returns after inflation. To turn $10,000 into $1 million at 8% annual returns, you need to wait about 59 years. Even if you're adding $500 a month to that portfolio at 8% returns, you're still looking at about 35 years to hit $1 million. But let's say instead you took that $10,000 and you used it to start a business or develop a high income skill. Maybe you use it to learn digital marketing and start a consulting agency. Or you use it to buy inventory for an e-commerce business. Or you invest it in equipment and training to start a specialized service business. If that venture succeeds and grows at even a modest pace for a business, let's say it generates $30,000 in profit in year 2, $75,000 in year 3, $150,000 in year 4, and you sell it in year 5 for 4 times annual profit, that's $600,000. Add in the profits you extracted along the way, and you could hit $1 million in under a decade. The difference is stark, and I'm not cherry picking here. A study published in the Journal of Financial Economics in 2018 analyzed the wealth accumulation patterns of high net worth individuals and found that approximately 78% of millionaires built their wealth through concentrated positions, either in a business they owned or in their career expertise, not through diversified investment portfolios. The diversified portfolios came later. After the wealth was built, here's what most people don't realize about the psychology behind this. When you diversify early, when you spread your money and attention across many different things, you're making an implicit assumption that you can't create value better than the market average. You're saying, I don't have any special insight, I don't have any edge, so I'm just gonna capture the market return. And for capital you've already accumulated, that's probably smart. But for your time and energy, which are your most valuable resources when you're trying to build wealth, that's a terrible assumption to make. Think about it. You have knowledge and skills and connections that are unique to you. You have access to opportunities in your specific geographic area, your industry, your network that other people don't have. When you spread yourself thin across a diversified approach to everything, you're not leveraging those unique advantages. You're actually throwing away your edge. Let me give you another concrete example that really drove this home for me. I interviewed a guy named Marcus who spent 15 years working in the logistics industry. He worked his way up from a warehouse worker to a logistics coordinator to eventually a regional manager. He was making about $90,000 a year, which is solid, but he wasn't building real wealth. He was maxing out his retirement accounts, doing everything right. But he calculated that even with promotions and raises, he'd retire at 65, with maybe $1.5 to $2 million in today's dollars, if he was lucky. Then Marcus realized something. He had spent 15 years learning exactly how logistics worked for mid-sized manufacturers. He knew their pain points, their inefficiencies, their needs. So at age 42, he did something that seemed crazy to everyone around him. He quit his job, took $40,000 he had saved up, and started a logistics consulting and coordination business specifically targeting mid-sized manufacturers in the industrial Midwest. For the first year, he made less money than he would have at his old job. His wife was stressed. His friends thought he was having a midlife crisis. He was completely concentrated. All his time, all his money, all his focus was on this one thing. But by year 2, the business was generating $120,000 in profit. By year 3, $210,000. By year 5, he had built it to the point where it was generating about $400,000 a year in profit, and he had systematized it enough that he only needed to work about 20 hours a week on it. At age 49, he sold the business for $3.2 million to a private equity firm that wanted to roll up similar businesses. Marcus went from a net worth of about $200,000 at age 42 to over $5 million by age 50. That would have been literally impossible through traditional diversification and career advancement. The key was he concentrated his resources into an area where he had a specific edge, a deep knowledge advantage that couldn't be easily replicated. Now you might be thinking, but Tom, not everyone can start a business. Not everyone wants to be an entrepreneur. And that's fair. But here's the thing. The principle of concentration versus diversification applies to your career too. Think about 2 different career strategies. Strategy 1 is the generalist approach. You develop a broad range of skills. You're decent at a lot of things. You can do marketing and some finance and some operations, and you know a bit of coding. You keep your options open. You're diversified. Strategy 2 is the specialist approach. You go deep on one specific valuable skill. Maybe you become one of the top experts in a particular type of data analysis. Or you become one of the best commercial real estate negotiators in your city for a specific property type. or you become deeply expert in a particular software platform that's critical for an industry. The generalist might have more job security in the sense that they can apply for lots of different jobs. But the specialist has income security because they can command much higher rates for their rare and valuable skills. A study by Georgetown University's Center on Education and the Workforce found that specialists in high-demand fields earn on average 68% more over their careers than generalists, even when controlling for education level. 68%. That's the concentration premium applied to career capital instead of financial capital. And here's where this gets even more interesting. The wealthy don't just concentrate their financial capital and their human capital. They also concentrate their attention and their relationships. Think about networking advice you typically hear. Go to lots of events, meet lots of people, collect business cards, build a big network. That's diversified networking. But if you study how successful people actually build valuable relationships, they do the opposite. They identify a small number of highly valuable relationships and they invest deeply in those. They become genuinely helpful to a small number of important people, rather than being superficially connected to hundreds of people. Reid Hoffman, the founder of LinkedIn, talks about this in his book about how he built his network. He didn't try to know everyone in Silicon Valley. He identified maybe 20 key people who were nodes in networks he wanted to access, and he focused on building deep, genuinely valuable relationships with those 20 people. When he started LinkedIn, many of those people became investors, advisors, early employees, or connectors to critical partnerships. That concentrated network strategy was worth billions of dollars. But let's get back to the specific question of investment portfolios, because I don't want you to misunderstand what I'm saying. I'm not saying you should take your retirement account and put it all in one stock. That's not what wealthy people do, and it's not what I'm advocating. What I am saying is that the traditional advice to spread your money equally across dozens of index funds is optimizing for the wrong goal if you're trying to build wealth rather than just preserve it. Here's how sophisticated investors actually think about diversification. They use what's called a barbell strategy. On one end of the barbell, you have safe, boring, diversified assets. This might be index funds, treasury bonds, high-quality municipal bonds, maybe some stable real estate. This is your foundation. This is money you cannot afford to lose. For most people in the wealth building phase, this might be 20 to 40% of your investable assets. This is your sleep well at night money. On the other end of the barbell, you have concentrated, high conviction positions. These are investments where you believe you have an edge, where you've done deep research, where you understand something the market doesn't. This might be a business you own or are starting. Concentrated positions in individual stocks you've researched thoroughly, real estate deals and markets you know intimately, or investments in areas where you have professional expertise. This is your get wealthy money. What you don't do is put everything in the mushy middle of mediocre diversification that's designed to give you average returns. The barbell approach gives you protection on one end and explosive upside potential on the other. This is essentially how many successful investors, from Ray Dalio to Nassim Taleb to Howard Marks, think about portfolio construction. Let me give you some specific numbers on how this might work. Let's say you have $100,000 to invest and you're 35 years old with a stable job earning $80,000 a year. The traditional advice would be to put maybe $70,000 in stock index funds and $30,000 in bond index funds based on your age. Over 30 years at average market returns, that might grow to about $1.2 million in today's dollars. The barbell approach might look like this instead. Put $40,000 in a diversified mix of low-cost index funds and treasury bonds. That's your safety net. That will likely grow to about $400,000 over 30 years with no additional contributions. Then you take the other $60,000 and you invest it in concentrated bets where you have an edge. Maybe you use $30,000 to start a side business. Maybe you use $30,000 to make a concentrated investment in an industry you work in and understand deeply. Let's say just one of those concentrated bets succeeds and generates a 10x return over a decade. That's $300,000. Now you've got $700,000 total, more than half the way to the $1.2 million you get from pure diversification. And you still have 20 years for that to compound. Plus you have the income from the business or the knowledge you gained from the concentrated investment experience. But here's the real kicker. With a concentrated approach, you're also building skills, knowledge, and relationships that increase your earning power. Maybe that side business you started doesn't even succeed, but the marketing skills you learned let you negotiate a $20,000 raise at your day job. Over 20 years, that's $400,000 in additional income. Maybe the concentrated investment you made in an industry taught you enough that you were able to switch to a higher paying role in that industry. The benefits compound in ways that pure financial diversification never can. Now, I want to address the elephant in the room. What about risk? Isn't concentration risky? Yes, absolutely. But here's what you need to understand. There are different types of risk, and traditional diversification only protects you from one type. Diversification protects you from unsystematic risk, which is the risk that any one particular company or investment fails. If you own 500 stocks in an index fund and one goes bankrupt, you barely notice. That's good. But diversification does absolutely nothing to protect you from systematic risk, which is the risk that the entire market goes down. In 2008, people who were diversified across stocks still lost 40 to 50% of their value. In 2022, diversified portfolios were down 20 to 25%. Diversification didn't help because everything went down together. More importantly, traditional diversification does nothing to protect you from the biggest risk most people face, which is inflation risk and purchasing power risk. This is the risk that your money grows slower than the real cost of living, and you end up unable to afford the lifestyle you want in retirement. If your diversified portfolio earns 7%, but real inflation in the things you actually buy is running at 5%, you're only getting ahead by 2% a year. At that rate, you're never building real wealth. You're just barely staying ahead. Concentration, when done intelligently in areas where you have an edge, actually helps with these other types of risk. If you build a successful business, that's an inflation hedge because you can raise prices. If you develop valuable skills, that's an income hedge because you can command higher wages. If you make concentrated investments in areas you understand, you might be able to identify opportunities that will thrive even in down markets. Here's a specific example of how this plays out. During the 2008 financial crisis, everyone who was diversified in stocks lost a huge amount of money. But people who had specific expertise and concentrated capital actually made fortunes. Investors who understood distressed real estate bought properties at massive discounts and made 10 to 20x returns over the next decade. People who understood banking and had the courage to make concentrated bets on banks when they were trading below book value in 2009 made 3 to 5x returns in just a few years. The diversified investors who stayed diversified got back to even by about 2013 and then continued getting average returns. The difference is that concentrated investors with specific knowledge were able to identify asymmetric opportunities where the potential upside was much bigger than the downside risk. Diversified investors, by definition, cannot do that because they're designed to capture average returns across all conditions. Now, let's talk about the psychological component of this, because I think this is where a lot of people get stuck. We're taught from an early age that concentration is reckless and that smart people diversify. This gets drilled into us so hard that it becomes an identity thing. If you diversify, you're responsible and prudent. If you concentrate, you're a gambler and you're irresponsible. But that's a false dichotomy. Smart concentration is actually the opposite of gambling. Gambling is putting money on outcomes determined by chance that you don't understand. Smart concentration is putting money and energy into outcomes you can influence based on knowledge and skills you've developed. When you start a business in an industry where you have 10 years of experience, that's not gambling. When you make a concentrated investment in a company whose products you use every day and whose financial statements you've analyzed thoroughly, that's not gambling. When you invest heavily in developing a skill that you can see is becoming more valuable in the market, that's not gambling. The real gamble is assuming that diversification will be enough to build the wealth you need. Let me show you the math on this. The median household in America has about $87,000 saved for retirement at age 60. At a 4% safe withdrawal rate, that generates about $3,480 per year in retirement income, or about $290 per month. That's what a lifetime of diversified saving and investing gets most people. Is that really less risky than spending 10 years building a business or developing valuable skills that could generate 10 times that amount? Here's what I think is really going on. The financial industry has a massive incentive to promote diversification because it's a product they can sell at scale. If everyone needs a diversified portfolio, then everyone needs to pay management fees on a diversified portfolio. Think about it. You can't charge someone a 1% annual management fee to help them start a business or develop specialized skills. But you absolutely can charge them 1% to manage their diversified index fund portfolio, even though the actual value being added is minimal since index funds basically run themselves. A study by the National Bureau of Economic Research estimated that Americans pay about $600 billion per year in fees and commissions to the financial industry. $600 billion. The vast majority of that is for wealth management and advice services that are largely focused on constructing and maintaining diversified portfolios. If people understood that concentrated wealth building, followed by strategic diversification, is actually how you build real wealth, that entire fee structure would be threatened. I want to be very clear about something. I'm not anti-diversification. Once you've built wealth, diversification is critical for preserving it. If I had $10 million, I would absolutely diversify that across multiple asset classes, geographies, and strategies. But the path to getting that first million or 5 million or 10 million, that's almost always through some form of concentration. And that concentration doesn't have to be reckless or irresponsible. Here's a framework for thinking about smart concentration. First, concentrate in areas where you have or can develop an informational edge. This means areas where you know something most people don't, or where you have access to opportunities most people don't. Maybe you work in healthcare and you understand which medical technologies are actually getting adopted versus which ones are just hype. Maybe you live in a neighborhood that you can see is about to gentrify before the real estate investors figure it out. Maybe you have a skill in your hobby that you could turn into a business, serving an underserved niche. Your edge doesn't have to be huge. It just has to be real. Second, concentrate your learning and skill development. Instead of trying to be okay at 10 different things, get really good at 1 or 2 valuable things. This might mean taking a pay cut early in your career to work at a company where you'll learn more. It might mean spending your evenings and weekends for a couple years becoming expert at something valuable rather than watching TV. The returns on concentrated learning compound faster than the returns on diversified learning. Third, use concentrated action with diversified backup. This is the barbell approach I mentioned earlier. Have enough diversified safe assets that you can sleep at night and handle emergencies, but use your concentrated bets to actually move the needle on your wealth. The exact ratio depends on your situation, but I generally think people in their 20s through 40s should have at least 50% of their net worth building efforts in concentrated positions if they're serious about building real wealth. Fourth, concentrate your time on high leverage activities. Most people diversify their time across 100 different small tasks and wonder why they never make progress. Wealthy people ruthlessly concentrate their time on the few activities that actually create value, and they delegate, eliminate, or ignore everything else. If you're trying to build a business, maybe 80% of your available time should go to the 1 or 2 activities that directly generate revenue or build the asset. If you're trying to climb the career ladder, maybe 80% of your work time should go to the projects that will actually get you promoted, not the busy work that feels productive but doesn't matter. Let me give you one more concrete example that ties this all together. I know a woman named Jennifer who worked as a software developer making $110,000 a year. She was 32 years old and had about $85,000 saved up, most of it in diversified retirement accounts. She did the math and realized that even if she saved aggressively and got decent returns, she'd probably retire at 65 with around $3 million in today's dollars. That's good, but it wasn't the life she wanted. She wanted to retire by 45 and travel and have real financial freedom. So Jennifer made a concentrated bet. She had noticed that there was a specific type of software customization that lots of mid-sized companies needed for a particular business platform, but there weren't many people who knew how to do it well. She spent 6 months of her evenings and weekends becoming the absolute best at this specific type of customization. Then she quit her job and started a consulting business focused only on that one thing. The first year was rough. She made about $70,000, which was $40,000 less than her old job. But she invested almost all her time into getting really good at marketing her specific expertise and delivering amazing results for clients. Year 2, she made $160,000. Year 3, $290,000. By year 5, she had built the business to the point where it was generating about $450,000 a year in profit, with 2 employees handling most of the actual work. At age 39, she sold the client list and the systems to a larger consulting firm for $2.8 million. Combined with the money she'd extracted from the business over the years, she had about $4.2 million at age 39. She had accomplished in 7 years of concentrated effort what would have taken 33 years of diversified saving and investing. The key was concentration. She concentrated her learning on one specific valuable skill. She concentrated her business on one specific type of client with one specific problem. She concentrated her time on the high leverage activities of marketing and delivery. She concentrated her capital on building the business asset rather than spreading it across index funds. And yes, it was riskier than just keeping her job and maxing out her 401k. But it was smart risk based on a real edge, not reckless gambling. Here's the action plan I want you to take away from this. First, separate your wealth building strategy from your wealth preservation strategy. For money you've already accumulated, especially money in retirement accounts, reasonable diversification makes sense. But for your wealth building efforts, your time, your learning, your next dollar of investment, think concentration. Second, identify your edge. What do you know that most people don't? What access do you have that others don't? What skills could you develop that would be rare and valuable? Spend some real time on this. Your edge might not be obvious at first, but everyone has something. Third, make a concentrated bet. This doesn't mean bet your entire life savings on one stock. It means take a meaningful amount of your time, money, and energy and direct it toward one opportunity where you have an edge. Maybe it's starting a business. Maybe it's a concentrated career move. Maybe it's developing one valuable skill. Maybe it's a focused investment strategy in an area you understand. But pick something and go deep rather than spreading yourself thin. Fourth, set a time horizon and success criteria. Concentration requires commitment, but it shouldn't be open-ended. Decide upfront how long you're willing to pursue the concentrated strategy and what success looks like. Maybe you give yourself 3 years to build a side business to $50,000 a year in profit. Maybe you give yourself 2 years to develop a skill well enough to get a 30% raise. Whatever it is, have a plan. Fifth, build your safety net, but don't let it become your ceiling. Yes, have an emergency fund. Yes, contribute enough to your 401k to get the employer match. Yes, have basic diversification in your retirement accounts. But don't let the comfort of that safety net prevent you from taking the concentrated bets that will actually build wealth. The goal of the safety net is to give you the freedom to take smart risks, not to eliminate all risk from your life. Sixth, study what actually wealthy people actually did. Not what they say to do now that they're wealthy, but what they actually did to build their wealth. Read biographies. Listen to interviews from early in their careers. You'll see the same pattern over and over. Concentration during wealth building, diversification during wealth preservation. Look, I get that this is a hard message to hear because it goes against everything we're told about money. We're told that diversification is always smart, that concentration is always risky, that the path to wealth is slow and steady saving in diversified portfolios. And for the financial industry, That message is perfect because it creates lifelong customers who pay fees forever. But if you actually want to build real wealth, not just have a comfortable retirement, you need to understand that concentration is how it happens. And I'm not talking about reckless concentration. I'm not saying put your life savings on red at the roulette table. I'm saying focus your efforts, develop real expertise, build real assets, make informed bets in areas where you have an edge, and be willing to go deep instead of spreading yourself thin. The math is simple. Diversification gives you average returns. Concentration gives you the possibility of exceptional returns. Yes, it also gives you the possibility of below average returns or even losses. But if you're concentrating in areas where you have knowledge and edge, you're stacking the odds in your favor. And even if a concentrated bet doesn't work out, the skills and knowledge you gain from trying are worth more than the foregone returns from another year of index fund investing. The wealthiest people I've studied all have one thing in common. At some point, they made a concentrated bet on themselves. They believed they could create more value by focusing their efforts than they could capture by just riding market averages. And they were right. Not because they were lucky, although luck plays a role in everything, but because concentration combined with effort and knowledge creates an edge that diversification, by definition, cannot have. So here's my challenge to you. Look at how you're currently allocating your time, your money, your energy, your learning. Are you diversified to the point of being diluted? Are you spreading yourself so thin across so many different things that you're not actually making progress on anything? Are you following the conventional wisdom of diversification because it feels safe, even though it's probably not going to get you where you want to be? If the answer is yes, it's time to make a change. Pick one thing. One area where you can develop an edge. One opportunity where concentrated effort could actually move the needle on your wealth. One skill that's rare and valuable. One business idea that solves a real problem. One investment area you can learn deeply. Pick one thing and go all in on it for a defined period of time. Will it work? Maybe, maybe not. But I can tell you with certainty that if you just keep doing what you're doing, if you just keep spreading yourself thin across diversified mediocrity, you're going to end up with mediocre results. And that might be fine. Not everyone needs to be wealthy. But if you're watching a video about why millionaires don't diversify the way you think, I'm guessing mediocre results aren't what you're after. The people who build real wealth understand something fundamental. Diversification is a tool for managing wealth you already have. Concentration is a tool for building wealth you don't have yet. Use the right tool for the right job. And right now, if you're trying to build wealth, the right tool is smart, informed, strategic concentration. Take the leap. Make the bet on yourself. Go deep instead of wide. That's how wealth is actually built.